Hey everyone, my name is Ryan and welcome back to my channel where I'll be sharing with you different Canadian financial planning tips and concepts. Now today what I want to talk about is the 6 mistakes or misconceptions that we should avoid when using RSPs. The RSP is the most common tool people use, but while they may have an RSP account, they may not actually be using it the most efficient way. And sometimes if used incorrectly, it can even do more harm than good. So we'll be discussing the top mistakes to avoid when using RSPs to make sure you're getting the most out of it. Now before we get into it, if you haven't already, please help us hit the like button and subscribe to our channel so you'll be notified for our future content. And it'll also help us a great deal with the YouTube algorithm so our content can reach more viewers. Now without further ado, let's get right into it. So the number one mistake to avoid is using your RSP as a savings account. Now, one thing we know about the RSP is that the money inside it will actually grow tax-free until you withdraw it. But when you're putting money inside a savings account within the RSP, you may only be getting 1 or 2% interest, even in today's super high interest rate environment, which means that yes, you're still getting a bit of tax-free growth there, but you're really not putting it into the best use. Another thing to note here is that with the interest rate we get from savings account, it's always going to be lower than inflation. So by putting money inside the savings account, while it's better than putting it in a checking account, it still doesn't make sense when we look at the math perspective because you're actually still losing purchasing power when you leave money inside a savings account. Because things like food or housing are actually getting more expensive faster compared to how much your savings is growing. So the better way to use an RSP is actually to treat it as an investment account, especially since the money inside the RSP, you're really planning to use it for either retirement or to use it for your first home. Generally speaking, the longer the time the money stays inside the RSP account without you accessing it, the more aggressive you can afford with the investments inside in order to get higher returns. When you put together a balanced portfolio, you can get an average of 7 to 8% return a year. And with all the investment growth inside the RSP account, you would not need to pay any taxes until you actually withdraw the money from the RSP. And that means your money is actually compounding a lot faster compared to another account that you may need to pay tax for every single year based on its growth. The second mistake when using the RSP is not knowing your contribution room and over contributing. Your contribution room depends on your income, and specifically it's 18% of your previous year's earned income. And that includes income from our job, from our business, or from our rental properties. But it does not include any income from dividends, capital gains, or investments. So for example, let's say you earn a salary of $100,000. So if we take this formula of 18% times it by 100,000, then that means next year you would have $18,000 of RSP contribution room. Now for 2022, the maximum RSP contribution room is $29,000, which means that when your income is above $162,000, then you would have reached the maximum limit. Not everyone has a savings to maximize their RSP every year. So if you don't use up all your RSP room, don't worry because it'll actually be carried forward indefinitely. And you can find the amount of your unused contribution room that you've accumulated all these years on the notice of assessment, which is a letter you get from the CRA after filing your tax returns. You can also download this notice of assessment online by registering or logging into your CRA account. Also, you can have as many RSP accounts as you want with different banks, but make sure your contribution total across all the different banks is still within your contribution limit, because otherwise there will be an interest penalty that's quite hefty, and it's 1% per month on any excess amount that you've contributed, which basically means it's 12% a year. Another note about your RSP contribution is that it is going to be affected by pension adjustments or company RSPs. For example, a lot of companies, they offer group benefits like RSP matching, which means that when you contribute money inside the company's RSP account, your employer will actually match and contribute the same amount into your RSP, and it's basically free money for you. So as an example, let's say you contribute $3,000 into your group RSPs, and then your employer also contributes another $3,000. Now in this case, how much of the contribution limit would be used then? Well, the answer is that it will actually use up $6,000 of your room, even though half of it actually didn't come out of your own pocket. So be mindful of this when you're planning ahead for your future contributions. For new immigrants, just make sure when you first landed, you need to wait until the next year after you file your tax return to gain that RSP contribution room. Number 3 is the RSP contribution contribution period. Now this is one of the tricky parts with RSP because this contribution period isn't from January 1st to December 31st. Instead, the contribution period is actually March 1st to end of February. So for example, if you want to lower your 2022 taxes right now, there's still a chance for you to do that by using RSPs because the deadline to do it will be February 28th of this year. And this setup really allows us to have a clearer idea what our total income is and then decide whether or not we want to buy any RSPs. So if you figured out how much income you've made in the entire year and you realize you owe a lot of taxes, then this would be the great time for you to consider buying RSPs so you don't owe as much taxes to the government. The number 4 misconception with RSP is that employer contributions to my RSP will give me additional tax savings. Now we know that when we contribute into RSPs, it creates a tax deduction for us, which will lower our taxable income and thereby saving us taxes. And when employers contribute into our RSP, it actually does the same thing as well. So it does give us a tax deduction. But one thing that's often overlooked is that your employer will actually add the amount of their contribution into your taxable income as a taxable benefit. So what that means is your T4 actually increased by the same amount. So using the same example as before, if your employer is matching you $3,000, yes, you do have a tax deduction which lowers it by $3,000. But on the other hand, your T4 would actually have increased by $3,000. So at the end, it actually cancels out and you actually get no additional tax savings at all. You will, however, still get a tax deduction for the portion that is coming out directly from your paycheck. That being said, RSP matching by employers is still one of the best ways to grow your money because they're basically guaranteeing that your money will double. And there's really no investments out there that can offer the same type of guarantee. So if your company offers RSP matching to you, then make sure you take advantage of it ASAP and set that up so matching can start. Otherwise, you're really missing out on free money that's on the table. But one thing to be careful is that some companies do offer company RSP, but they may not actually offer matching. So pay attention to that because if there's no matching involved inside, then there's really no benefit of using it. And in fact, there may be some disadvantages as well because usually with group RSPs, the investment choices will be quite limited or you may not even have control of what is invested in. On top of that, there may be also additional administrative fees when you want to make changes to your investments or when you want to make withdrawals. The number 5 mistake when using RSP is claiming your tax deductions right away. One thing a lot of people don't know is that with the RSP tax deduction, you can actually choose to defer it or carry it forward indefinitely. And why we might want to do that is because depending on how much income we're expecting in the near future, it may actually make more sense for us to save it and use it later on. As an example, let's say you've contributed $10,000 in your RSP. And if your income is $80,000, then that means you would be in the 28.2% tax bracket. So how we calculate the amount of tax savings you get from contributing $10,000 of RSP is that we take $10,000 times it by your tax rate, which is 28.2%, then that would equal to $2,820 in tax savings. Next, we want to look at how much income we're expecting in the following year. So let's say next year you're expecting $120,000 of income, then you would be at the 38.29% tax bracket, which means using the same formula, we would get $3,829 in tax savings. So what that means is that if we actually saved our tax deduction for next year to use, we would get $3,800 instead of $2,800 in tax refunds. And that's a huge difference. That's a 36% difference in tax refunds just by delaying the tax deduction for 1 year. So then in this case, you need to ask yourself, if I use the tax deduction now and get the $2,800, can I safely expect to get 36% return by investing it? And most likely the answer is no. Then that means that you should probably save the tax deduction for next year unless there's a really good reason to do so or if you have some urgent need for that money. And that's why when people say you don't need to use RSP because you're young or you're in a lower tax bracket, it's technically not true because you can still take advantage of the RSP and grow your money tax-free inside and save your tax deductions for later when you do expect a higher income. And if you expect your income to stay relatively the same in the future years, then it might even make more sense for you to get the tax refund right away and reinvest that. And number 6, and the final mistake for using the RSP, is putting your emergency funds inside the RSP account. This is a huge no-no because withdrawals from the RSP will add onto your income and become taxable. And there's really only 2 exceptions to this. The first exception is the home buyer's plan, which means you're using the money to buy your first home. The second exception is if you're going back to study full-time, which is called the lifelong learning plan. And if you expect to use this money for any other reason besides these 2 reasons, then you should really think twice before putting money in the RSP account, unless it's for retirement purposes. The way RSP is structured is that it will actually help us grow our money tax free, and then down the road when we're retired and we probably are in a much lower tax bracket, then we can withdraw the money at that time to spend and pay a lot lower taxes compared to when we're working full time. So generally speaking, we should really only withdraw from our RSP as the last resort when we've already withdrawn from our TFSA or from our non-registered accounts. That being said, if you expect yourself to maybe take a whole year off without income next year or in the near future, then it also might be worth considering putting some money into RSP so you can get the tax deductions while you're still working. And in the year when you start working, you can actually take that money out from your RSP to spend and pay a lot lower taxes or no taxes at all.